Hey everybody, Rob Maurer here, and today we've got a really interesting topic as Ford has published their restated financials, splitting up their business segments. So isolating out EVs, which is one of the first times we get access to these types of financials to compare with Tesla. Then we've also got a report on the status of the EV tax credit and a couple other items as well. Quick look at the stock. After a strong start today, Tesla trailing off throughout the day, finishing up just 0.6% to close at $192.22, while the Nasdaq was up 1% on the day. All right, let's get right into these restated Ford financials. This is a fascinating first look at how Tesla's competition compares from a profitability perspective. Often we see vehicle specs and things like that. We talk about how Tesla is better on profitability, but actual numbers are really hard to come by, especially from legacy auto. They tend to hold these very close to their chest. So kudos to Ford for actually being a little bit more transparent here. I think this goes a pretty long way in showing that they are committed to EVs. So how have they split this up? They've got Ford Blue, that's basically legacy ICE hybrid vehicles, Ford Model E, that is EVs, and then Ford Pro, which is commercial vehicles and services. So this does actually give us a pretty clean look at Ford's EVs. This is mostly the Mustang Mach-E, the Ford F-150 Lightning. It is still a little bit convoluted, as is pretty much inevitable with a business of this type, but as you can see from this diagram, there are still some flows between these businesses. And as far as I can tell, we are still missing a couple of key financial metrics like gross profit by segment, free cash flow by segment, but still way more than we've had before and tons of insight that we can take away from this information. So looking at what Ford has shared, they've really given us 4 key metrics and we'll dive into those, but they are wholesale units, including joint ventures, revenue, EBIT, so earnings before interest and tax, and EBIT margin. For 2022, they say that wholesale EV sales were 96,000, revenue was 5.3 billion, EBIT earnings was a $2.1 billion loss, and perhaps the most interesting thing, their EBIT margin, negative 41%. So let's take a look at this in a spreadsheet. Ford shared this. I've cleaned it up a little bit to make it easier to understand. So we'll look at each of these metrics and their year-over-year change from 2021. So 96,000 EVs, that was up 57% over the 61,000 from 2021. And that put their 2022 EV sales at about 2% of their overall unit sales. Kind of interestingly, they do have a footnote here that says that their EV wholesales, parentheses included above, we're actually 128,000, so I don't know if that's some EVs that are going into Ford Blue or Ford Pro. Again, things are still intertwined to a degree, but looking at that number, that actually increased 103% year over year. So depending on what that exactly means, we'll try to figure that out, but depending on what that means, their year over year growth might be a little bit stronger than what that Model E specific number looks like. Taking a closer look at revenue, again, that was about $5.3 billion in 2022. That was up 70% year over year. So while units were up 57%, revenue up 70%, and with EV units being about 2% of the total, EV revenue was a larger share at about 3% of total revenue. So now we look at profitability, which is really the most interesting thing here. Ford's EBIT loss on Model E last year, $2.1 billion, in 2021, $900 million, so that loss expanded by $1.2 billion despite a more than $2 billion increase in revenue or a 70% revenue growth rate. So rapid revenue growth, but leading to more significant losses and actually leading to a more significant rate of loss, with margins declining from negative 29% in 2021 to negative 41% in 2022. So that's almost a 12 percentage point decline during a year where there was actually really strong vehicle demand. If we put all these numbers together, we can get a sense for that. This isn't perfect because we don't have numbers for things like leasing, but if we divide reported revenue for Model E by the wholesale units, we get a $51,000 average selling price in 2021 and a $55,000 average selling price in 2022. So about a $4,000 increase year over year, or 8% for this average selling price proxy. But if we do the same calculation for EBIT, for earnings before interest and tax, divide that by wholesale units, we get a $15,000 EBIT loss on each sale in 2021 and a $22,000 loss on each sale in 2022. So even with the benefit of $4,000 in additional revenue for every vehicle, the loss increased by $7,000 for each vehicle. So this should be extremely eye-opening to people. Just for context, Tesla's EBIT number for 2022 was about $15.5 billion. They delivered about 1.3 million vehicles, so their average EBIT per vehicle sold was about $12,000. That means there was a staggering roughly $34,000 difference in average EBIT per vehicle sold worldwide from a Ford EV last year and a Tesla EV last year. Now, obviously, it's not a completely fair comparison. Tesla is at a much greater level of scale than Ford, but that's part of the point. Ford still has a long way to go to get to that level. They've got a lot of work to do, and they're competing with Tesla, who already has this structural cost advantage. The hope for Ford is that the losses that they're reporting in this business right now allow them to get to that scale, cut those costs down, and have a profitable EV business. Ford thinks they can get there by the end of 2026. They're targeting an EBIT margin of 8% by that point in time, and production capacity of EVs of 2 million per year at that point. So you'll probably hear 2 million for Ford in 2026. No, they're not going to do 2 million in 2026. They'll have production capacity for 2 million at the end of 2026. But they think they can move this down 41 EBIT margin number up 20% from scale, 15% from design and engineering, 10% from battery, 3% from other, which includes new dealer standards, software and services, Inflation Reduction Act benefits, and lower raw materials prices offset by lower ASPs from competitive pricing. So good to have a plan, but again, a very long way to go to get to profitability for Ford. If anyone still has the argument that legacy automakers can just come in here and leverage their scale to beat Tesla on cost or something like that, well, we now have pretty irrefutable proof that that is not going to happen based on what Ford has disclosed. This is not something that Ford expects to get better immediately either. They did actually give some guidance for their earnings before interest and tax for 2023 for each of these segments. They say Ford Model E, the EV unit, negative $3 billion of EBIT for 2023. For some context, looking at macro trends numbers, this is Tesla's annual EBITDA. I haven't gone back and double checked this, so presuming these are correct. And we also have the DA portion in there, so depreciation and amortization that you have to take out to make a fair comparison. That was $1.6 billion in 2017. That's the lowest number here that's probably relevant. So without having the exact EBIT number, it looks like Tesla's worst EBIT loss was probably $1.5 billion. And again, Ford's saying they're going to lose $3 billion EBIT next year on EVs. And by the way, something that needs to be considered with all of these numbers, Tesla was starting from scratch, right? Ford still has infrastructure that they can leverage, whether that's service, dealerships, third-party charging stations that exist today. There are probably development costs that are hidden in Ford Blue that has hybrids, for example. I mean, maybe some of that is happening the other direction. Maybe they're hiding some of their losses from Ford Blue in the EV segment for now. Tough to say for sure, but it just, again, highlights how efficient Tesla has been through this entire process. We've already seen that when we look at Rivian, when we look at Lucid. Their EBIT losses are worse than Ford. All of these other companies' numbers so far have just made Tesla look that much more impressive. So this will be fascinating to follow over time. Hopefully we do get a little bit more information on things like gross margin, gross profit. That would give us a little bit more granularity on what exactly is driving the losses. Makes it a lot easier to figure out when that type of a situation might change. All right, we'll move on from Ford financials for now. We do have another update from Ford that was earlier this week. They announced the all-electric Ford Explorer for Europe. Unfortunately, they haven't shared many details yet, including leaving out the range, but they did say that this is anticipated to cost less than 45,000 euros, which at that price, as we have just learned, is likely to continue to contribute to these significant losses in the Ford EV business. And by the way, with all of this, Ford has actually been doing okay with EVs, at least relative to the rest of the US competition outside of Tesla. It doesn't necessarily mean that every other automaker is looking at this exact same situation, but I mean, it's got to be pretty similar. And then you start to think about how this looks if you don't have any profits from the ICE vehicle business. If that starts to decline, those profits can fade fast, and then all of these financials start to look incredibly bleak very quickly. So yeah, I think this probably helps explain why Tesla competitors might be pretty nervous about price cuts. Anyway, now we'll actually move on. We do have an update from Electrek today on the status of the EV tax credit. We've talked a lot about how we're supposed to get more guidelines from the IRS and the Treasury about how this is going to be structured specifically as it pertains to the qualifications around battery materials, battery minerals. So we're still waiting on that, but Electrek today saying that they have learned from sources familiar with the matter that Tesla has communicated to employees that it expects the IRS to release the guidance any day now, and the automaker expects to lose the full credit on the Model 3 standard range, which obviously uses lithium iron phosphate packs from China. So just to be clear, this has always been the expectation for this trim, at least until Tesla does something different with those batteries or with the trim setup for Model 3. We're just kind of living in a temporary exemption period right now while we wait for those guidelines. So kind of circumstantially, it ended up being eligible for this time period, but that was probably not the initial expectation from Tesla, so they should have had plenty of time now to think about how they want to manage this going forward. That may have played a role in the disappearance of the long-range non-performance Model 3 from the design studio last year. That still hasn't come back. We've seen some in inventory. But I don't know, it kind of feels like Tesla may just reorganize the lineup, especially as we have these Project Highland rumors, a lot of variables around the Model 3 right now. Anyway, the real question for the tax credit has really always been, what is the level of eligibility going to be for Tesla's other vehicles? I think everybody expects that the 4680 vehicles would be full credit, but what about the Panasonic 2170 packs? Obviously, those are built in the US, but do the materials and the minerals meet those thresholds? Does that drop Tesla down to a half credit? What's the status there? That's what we're waiting to figure out. But Electrek is saying that they are expected to retain access to the full tax credit for those cells, and that the battery material sourcing might be an issue, but Tesla appears confident that it won't be the case, since a large portion of those materials are from countries with free trade agreements. So everyone's still waiting for guidelines, but it's a positive sign, I think, if Tesla is feeling that way. That's probably a bigger story than the LFP packs losing the credit here, which we already knew was going to happen. All right, last couple of items here. Thanks to Dave Lee for sharing this on Twitter. Looks like Tesla is now offering an extended service warranty. It's a little bit surprising since I don't have any voicemails from Tesla trying to reach me about this, but it looks like you can extend your warranty for 2 years or 25,000 miles, whichever comes first, with the price depending on the vehicle model, starting at $1,800 for the Model 3 up to $3,500 for the Model X. So I'm not sure on the value proposition of that. Tesla does say that there is a $100 deductible per visit, so that's something to keep in mind with this, but might be a nice option for some people for peace of mind and could be a good margin for Tesla as well. Last item for today then, Tesla has started to quietly roll out a new product. This is a metering product that's meant to be used in conjunction with the wall connector. Tesla is calling it the Smart Current Limits Meter, and you can see the part number listed here in the electronic parts catalog. Basically, this allows for people that don't want to or can't change their panel or breaker setup to have the wall connector dynamically adjust charging power based on the capacity available at any given point in time from the panel. So if it's experiencing high load from other needs, then it will reduce the charging power for that period of time. When those needs are satiated, then it can amp up the charging power again. So it might be a nice option for some people. Not sure if this is something customers buy or if this is something that Tesla works with installers on, but it is something that is out there. All right, that is where we'll wrap it up for today. So as always, thank you for listening. Make sure you're subscribed and signed up for notifications. You can also find me on Twitter at Tesla Podcast, and we'll see you tomorrow for the Friday, March 24th episode of Tesla Daily. Thank you.